Hello, everyone. Thank you very much for coming to our session. I'm Yuki Kamimoto, a CEO at N.Avenue Inc. We are the operator of the Japanese version of Coindesk, which is the world's largest digital asset media. So I'm so glad to be joined at this session. As a moderator, I would like to briefly set a tone for the panel discussion today. So I think we all have been watching some big shifts recently in this space. And maybe because of the approval of Bitcoin ETF last year or the recent legal development in the US under the President Donald Trump's new administration. But all these factors clearly opened up the doors for the institutions to step into this space, right? And it's so different, right, from what we have seen for the past few years. And I think everyone really feel that this market is no longer on a sideline or niches. It's obviously going into the mainstreams. But for this amazingly decentralized market to truly move into mainstream, one thing is, I think, absolutely essential, and I think it's reliable data. So data is the foundation of trust, transparency, and even informed decision-making. And now that we see more institutions coming along, the need for the accurate price data, indexes, rating is much greater than ever. So that's why I thought we are so fortunate to sit together today with these three leading companies at the forefront of that challenge, right? So for the next 35 minutes, we're going to explore what we need to make it happen and what's behind it. Okay, so before we kickstart the conversation, why don't you guys have a brief introduction and short remarks? So you start?
Okay, I start. Good morning, everyone. I'm Damien. I'm a head of APAC and EMEA at Keiko. So to tell you a little bit about what we do at Keiko, I like to tell you the story behind the name of Keiko. That has something to do with Challenger Deep. So for anyone not aware about what is Challenger Deep, that's the deepest point on Earth. That's in the abyssal point in the Mariana Trenches, which is located in the Western Pacific Ocean. Keiko is actually the name of the most successful expedition down Challenger Deep, and that managed to bring the most and the best of the value up to the surface. So I guess you see the analogy, and that's pretty much what we do at Keiko. So Keiko, we're a provider in crypto market data. We do analytics, rates, indices, monitoring for institutional investors, for regulators and financial services. Our mission is to bridge traditional finance and a blockchain ecosystem by delivering trusted and actionable financial data. And we do that for over 10 years now across all regions from APAC, US, and Europe by delivering trusted data and helping companies to navigate among both on-chain and off-chain ecosystem of crypto. That's Keiko.
Thank you, Damian. Jim, please.
Great. Well, hello, everyone. My name is Gene Fong, I'm from Moody's Ratings, and I guess I'm here to represent traditional finance. So at Moody's, of course, our role has been to provide clarity around credit risk to investors. And in my role at Moody's, I kind of have two separate hats. And my first hat is very traditional. I'm in charge of the team that provides ratings for sovereigns in the Asia-Pacific region, doing the government bond ratings for all the governments in Asia. And in my other role, I am the regional leader for our digital finance strategy. So that's what I'm here to talk about on this panel, and look forward to sharing more about that strategy with everyone here.
Thanks. Yusutus, please.
Hi, everyone. So first of all, let me say thank you to Upbit for inviting everyone of us to speak today on this panel. My name is Yusutus 슈라이너. I'm Global Business Development Manager at Coinmagetcap. I don't think Coinmagetcap needs too much introduction, but we are one of the largest data provider in the digital asset space. Just to give you some numbers, we track over 20 million digital tokens on CoinMarketCap by close to 1,000 exchanges. And as a quick number of reaffirmation, CoinMarketCap has around 100 million active users and close to 1 billion page views per month. So if you're saying crypto is going mainstream, I think we're already there.
Great. Thank you very much, guys. So I want to start with asking Yusutus about market trends, because CoinMarketCap, I think, tracks like billions of data in a daily basis. So what trends are you seeing recently, and what do you think is gonna happen, I would say, for the next 12 months?
Definitely. So I think what's interesting, if you compare the market of the last, let's say, 12 to 24 months compared to previous years, is that we now, with the influx of institutional capital and the influx of ETF capital flows, we see like there's a complete divergence in the market, meaning that now we see basically the majors moving completely different than, let's say, altcoins or meme coins, because there is like a market sentiment that is mostly driven by retail, and retail focuses not that much anymore on the majors because they see more beneficial gains or, let's say, a bit more advantages for their investment strategies in the altcoin or low-cap altcoins. So this divergence in the market is completely new, that sometimes we have, let's say, negative market sentiment, but even though we still see huge influx of ETF capital and institutional capital. And this professionalism of the market also is reflected, I would say, in different trends that we see. And I want to highlight just 3 of the trends that we are recently closely observed at CoinMarketCap that are probably extremely relevant for the future in the next 12 months. One of them is stablecoins, and I think I don't have to tell anyone in this room that stablecoins and yield-bearing stablecoins will be one of the major products that will drive adoption of digital assets, because we see, for example, many M&A transactions where large-scale stablecoin payment providers are being bought up, and we see more and more adoption of stablecoin payments. This is trend number 1. Trend number 2 that we are also seeing at the moment that shows this professionalism is deep DeFi. Deep DeFi means that we are now having more and more DeFi providers that not cater only to retail users, but also cater to institutionals and sophisticated investors. Meaning now we have, for example, derivatives on chain or just extremely complex indexes on chain as well. And I think this deep DeFi also caters to institutionals, which are suddenly more and more driven to be on chain. And the last trend that we are seeing, and I think this is the most important one, and you're probably hearing about it today several times now as well, is RWAs. And RWAs basically lead to a movement of traditional capital market products to be on-chain through, for example, tokenized stocks, equities, or bonds. And we started to track this data on CoinMarketCap as well. And with this, and here we are seeing like more and more large-scale traditional finance players are coming into the space. So what we are observing is the market is getting more professional, and the market is definitely getting more institutional as well.
If I may
Sure.
jump in, Yuki, just to reflect and complement on what just mentioned, and reflect on the index side. Obviously, the launch of Bitcoin and Ethereum ETF has been a huge success in the US. I'd like to share two numbers, being from a data company, obviously. I have a few metrics I love to share. So first is the volume of Bitcoin spot trading that now counts for almost 7% just before the daily fixing of the ETF. That was 4% last year, so that's pretty significant. The other one is the ETF trading makes up 40% of Bitcoin trading volume daily. So that shows how those products influence like the overall liquidity of the market. So in terms of market trend, if you combine like a more crypto-friendly regulation together with new ETF product like potentially basket or staking, also together with upcoming approval of ETF in some regions, Korea being in the pipe for the coming months potentially, then it results in more institutional adoption and expects indeed more growth in the ETF space.
Thanks. Now I want to come to Jane. I've been really curious, like what and how a traditional rating agency like Moody's started engaging with digital assets. So could you elaborate on the journey in this
Sure.
space?
I mean, I think when it comes to digital assets, we've really been focused on sort of three broad asset classes and really around the tokenization of RWAs. So we have been working mostly with digital bonds, tokenized funds, and we're doing a lot of work right now on digital cash, including stable coins. And I think across all these asset classes, our objective is really the same, which is to provide the market with a credit rating that really enhances the ability of these digital assets to go mainstream, because investors who look at our credit ratings get the same information about probability of default and loss given default, whether you're looking at a rating for a traditional asset or digital asset. So no differences. And the reason why we think we can do that is because fundamentally, credit is driven by the same type of fundamental factors, whether the asset is ultimately in a traditional or digital format. So for all of those fundamental factors, we have a library of methodologies for all kinds of sectors and companies that we've been using for a long time. But of course, digital assets do have some unique risks. So on top of that, we do layer a digital assets risk assessment framework. So coupling that with our traditional methodologies, we've been able to provide ratings for digital bonds from as early as 2017. So obviously for digital bonds, most of the issuers so far have been banks, government entities, or development banks. So that's the core methodology set that we use, the bank rating methodology or the sovereign methodology or the multilateral development bank methodology. And on top of that, we layered our digital asset risk assessment framework. And similarly for funds, we started providing credit risk assessments for tokenized funds in 2024. And that's built upon our bond funds risk assessment framework, which has been out in the market for a long time. And when it comes to stablecoins, we haven't published any ratings yet, but we're looking we're doing a lot of research and think that for a lot of the structures that are undergirding stablecoins, we do have a lot of methodologies that would come into play. And for other aspects that are relatively more unique, we're doing more research on setting up methodologies to address those. So, I think ultimately, in order to really help bring these digital assets mainstream, what we're trying to provide for the market is basically a credit rating that investors can use, and they can look at it agnostically, whether it's a traditional asset or a digital asset.
So you've been covering like RWAs, but not exactly on cryptocurrencies, am I correct?
I'm sorry?
You've been covering the RWAs, including like
Yeah.
tokenized bonds and stablecoins, but not exactly covering the cryptocurrencies like Bitcoin.
Yeah,
or
that's right.
Okay, I got it. And now I also want to ask you, Jen. So then, from the data credit analysis perspective, what's the difference between financial traditional finance and
Yeah.
digital finance?
Well, as I was saying earlier, I think the core drivers of credit are the fundamentals. And so for that, we have our traditional methodologies. But there are unique aspects of digital assets, and we've developed our digital assets risk assessment framework to assess those. And this framework basically looks at 4 dimensions. First, we look at platform risk. And basically, is the technology platform set up in a way that we think is resilient to shocks and is fit to purpose? Then we look at smart contract risk. We've looked at, in traditional finance, terms and conditions and really thick offering circulars. When those get translated into software, how do we control for potential bugs? What contingencies are in place that the platform operator can bring to bear if there are issues in terms of the software? We also look at asset representation risk, which is basically to ensure that investors in the digital asset have the same rights to the underlying real-world assets, and if you are, that they're treated in a pari passu basis with investors in the traditional assets. And then finally, we look at external risks. So here, we think that, in particular, cyber risks are very relevant to digital assets, and also regulatory risk, which I'm sure we'll talk about a lot, but it's obviously an emerging sector and a lot of shifting regulations around how digital assets are being treated.
Understood. Damian, we actually had received the question from the online audience, and it's actually exactly what I wanted to ask. So I think Kaiko is collecting various data from all over the world, but what's the unique data collected specifically in Korea compared to the rest of the world?
Yeah, that's actually interesting, since Korea is a very interesting market and pretty surprising, and not only because of K-pop on Netflix, right? So I'd like to mention a few metrics. Well, South Korea is actually the second largest crypto market in the world. So I have 2 metrics to share here. One is 35% of global fiat trading volume is, over the past 5 years, has been traded in Korean won. And just behind USD, that stands for 45%. All other currency, including euro, are way behind and below 10%. Second is $700 billion has been traded on Korean exchanges since the start of the year. That's versus $800 billion in the US. So clearly that's a huge market, and that's interesting when we look at exchanges. A bit, for example, is ranked among the 5 biggest exchanges in the world by trading volume, and is quite frequently ranked second behind Binance. That's actually interesting, considering like the specific of South Korea, since only local resident can invest in Korean exchanges, which is way different from a global platform which benefit from a much broader audience. And that actually can be explained by a few cultural criteria. One is the widespread adoption in South Korea for any technology, mainly due to very fast internet speed. Second is, in general, a pretty risk-loving culture in Korea. And last but not least, an interesting mono-ethnic society in Korea where we see trends can gain traction pretty quickly. But that kind of result in a few challenges when it comes to exchanges, which are super concentrated in South Korea. And that comes from the Special Financial Information Act amendment in 2020. So before that date, there were actually 63 exchanges in Korea. Now it's only 5 been licensed. And honestly, you only take the 2 major who are grabbing more than 95% of the market share. So that's here where South Korea is having capital control over the crypto exchange that kind of isolate a little bit this market and bring some quite interesting situation. We've seen, for example, situation like the kimchi premium or the listing pump. So for those who are not aware, so kimchi premium is basically the price gap that you see in Bitcoin on Korean exchanges versus global exchanges. And that's typically the results of a very pushy retail-driven market on one side with a lot of demand and a poor liquidity, no real institutional trading on the other side. So that results in pretty volatile market in some circumstances and quite low liquidity. And there is one metric I'd like to share to illustrate that phenomena is the volume to liquidity ratio. That basically is the volume traded daily versus the 1% market depth liquidity. So for Korean exchanges, we have something like 250 X for Bitcoin, which means that daily trade exceed the available liquidity by 250 times. In comparison, on global platform, it's something around 50x. So that shows the challenge that we have on liquidity in South Korea. And that kind of illustrates the challenge when it comes to building and building prices on Bitcoin based on Korean exchanges. And that's typically what a company like Kaiko is trying to do when building rates or pricing over those cryptocurrencies.
It's very interesting. So another point I'm interested in is that the bridge between CEX, centralized exchange, and also DEX. Like, how does Kaiko ensure the consistency and comparability between them?
Sure. So first you need to have like a proper mapping, like clean. So in terms of data collection, the approach is that we need an exhaustive mapping, clean. You need to basically index all blockchain smart contracts, and that's key. Then you need to get a deep understanding of the microstructure of all those decentralized exchanges. And then you usually prefer quality over quantity. That's because by focusing on the most important DEX platform, for example, you know that usually you'll see most liquidity concentrate on those platforms. And I'll take the example of Uniswap that handles more than 95% of Ethereum DEX volume. So as a result, pricing data kind of manage to leverage on both centralized and decentralized exchanges to build a solution like fair market value, which is a fair and robust representation of what's the market look like and what's the price look like for a given crypto asset. And we cover that for all type of crypto assets and still being quite responsive to market moves.
Mm-hmm. Thank you. So now, Yusutus, speaking of the uniqueness in this, of the data in this space, CoinMarketCap has various features beyond just tracking the price data, like user voting, sentiment. So what product or features are you most excited upcoming years?
Mm-hmm. Definitely. So I think there's like, for us at CoinMarketCap, one of our main goals is basically making crypto more accessible. And here, of course, we have the challenge that we are catered to retail investors, but we also want to cater to institutional investors. So basically, we have to play both sides of the coin. And we recently launched 2 products that are actually in this way kind of nice. because they make crypto more accessible towards retail as well as institutionals. And one of them is CMC20. And CMC20 is our second index, actually. We have a CMC 100, and now we launched CMC20 as well. And the nice thing about CMC20 is that it will be an investable product, meaning that with one-click purchase, you can get exposure to the 20 most relevant crypto assets in the market, which of course makes it on the one side for retail, but also for institutionals, much more accessible to invest in the majority or the majors in the crypto token world. This is product number one. Product number two, and this is personally my favorite, is CMC AI. And CMC AI is our AI tool that basically aims to give you a data analyst at hand to utilize all the data that we have on CoinMarketCap. We're talking about historic data, we're talking about market sentiment data, we're talking about news, volume, etc., and utilizing all of those data points to give you this insights and in-depth research capabilities. And here the interesting thing is that on the one side it's for retail users that don't know that much about crypto or analytics, but it's also targeted towards, let's say, sophisticated institutionals. So I recently, for example, spoke to a hedge fund that basically told me they are utilizing this tool to check check their early conversions for example, early theories and make them more, let's say, make them more sound by verifying it through our CMC AI tool, which I think is kind of interesting because so it's a tool that's not only for retail but also for institutionals. And this is like what we are actually trying to do with CoinMarketCap all the time is making crypto more accessible. And I think this is extremely important to get more and more adoption into the space.
Interesting, thank you, Justus. Now we want to move on to the topics more about integration into traditional finance. So, Jin, so we see much progresses in regulatory frameworks all over the world. So how, what role do these regulatory frameworks progress play in Moody's rating?
Yeah, I think technically speaking, our methodologies and approaches are supposed to be neutral. They do apply globally, and they're neutral in terms of different types of regulatory systems. But obviously, the progress in terms of regulation is generally, I think, positive from a credit perspective because it is giving us more clarity around the rules of the road, and it's giving us more transparency to data, and all of that helps us get a better view on the underlying fundamentals and gives us a better opportunity to assess the credit. I think if you look at some of the research that we published at the end of last year in our 2025 outlook for digital finance, we did note that we were seeing very steady progress in terms of regulation in the EU and in many parts of Asia, including Hong Kong, Singapore, Korea, and Japan. But I think obviously this year with the Genius Act in the US, we're seeing a big step forward globally in terms of the kinds of regulatory advancements that are being made and helping to kind of integrate a lot of these players that are kind of intentionally going to be global, right? And I think having a more synchronized global regulatory landscape does help reduce regulatory uncertainty. So I just give one example. We do rate Coinbase Global, and as an exchange, one of the risk factors that has been a concern is regulatory uncertainty, but we actually currently have their rating on review for upgrade because we are seeing progress around some of the uncertainties with SEC regulation, and that has a direct credit impact on the ability of Coinbase to generate funds. So that's a real world example of how we see regulatory clarity impacting some of these digital asset companies.
That makes sense. So now not only crypto players, but also major companies or even countries are trying to issue some kind of tokens and at least like involved in this digital asset space. So what do you see the like impact in terms of credit profiles in the longer term?
Yeah, I mean, I think for this question, I have to say on the one hand, there's going to be a lot of potential benefits, and the promise is tremendous. On the other hand, there are some risks that we have to be mindful of going forward. So in terms of the benefits, I think we're all very aware of and would understand that the opportunity that fractionalization can bring really holds great promise in terms of liquidity and accessibility. So for any issuer, whether you're a corporate or a sovereign, if you're able to tap a broader and more liquid pool of investors, that's generally positive from a credit perspective, right? Secondly, tokenization does have the potential to bring a lot more transparency to data, and so having a lot more transparency can help companies and governments as well be more effective at risk management. And so that's another way in which tokenization is potentially positive from a credit perspective. And then when you combine that, I mean, obviously at a company level, that gives the opportunity for companies and banks to do a lot more in terms of capital management as well. So all those are on the positive side. There are some risks that I would highlight. I mean, number one, I think regulatory uncertainty, which we've already talked about, that is a key risk factor. Technology risks are also there. A lot of these platforms have relatively limited track records, and I think over time some of that will be worked out. But in the meantime, the operational sustainability, the resilience of these platforms, as well as the exposure to cyber risk are also risks that we're very focused on. And finally, just in terms of entire sectors, the way a lot of these technologies are being adapted could be very disruptive. And so there's sort of a strategic element for a lot of financial institutions in particular when it comes to the digitalization of finance.
Mm-hmm. Okay. Justus, I want to ask you about CoinMarketCap's view. So I think, in my understanding, CoinMarketCap has been more focused on relatively retail investors, but now covering institutions' needs as well. So what data signals do you think like institutions should pay attention to?
This is an extremely important question because a lot of institutionals that are moving now in the digital asset space, they are more used to, let's say, the quantitative metrics. And in crypto, as soon as you move away from the majors, I would say the qualitative metrics are nearly as important as the quantitative ones. And here, for a lot of those institutions, I would say it's extremely important, for example, to look at fear and greed indexes, to look at altcoin cycles and altcoin capital flows, to look at overall market cycles, because the quantitative metrics are just not sufficient enough to really cover the whole picture. And especially if you're especially if you're moving away from the majors and going more in the altcoin territory, those metrics become more and more relevant. We are actually trying to track those on CoinMarketCap as well. We have a fear and greed index, for example. We have an altcoin indicator, altcoin cycle indicator. So we're trying to quantify those qualitative metrics, but I think those are extremely important to also take into consideration if you are an institutional player that's mostly knowledgeable in the TradFi space. Don't forget the qualitative metrics as well.
Thank you, Justus. Now, Damian, I think Kaiko has been working on indexes as well, right? So I'm interested, like, what role does indexes play in a combination between traditional finance and digital assets?
Okay. Okay. It may sound a bit difficult when being outside the crypto industry. Let's take the example of Bitcoin reference rate, for example. May sound like the price of Bitcoin is something that you simply can get easily on Google and you get a price. But actually, unlike traditional finance, the crypto market is super fragmented. You have hundreds of exchanges, both centralized, decentralized. Which price are you going to take? So that's where the index methodology is becoming a bit complex. You need to make a proper weighting on the exchange. So we have an exchange ranking, so based on different criteria, such that the governance of the exchange, is it a regulated exchange? What about the quality of the data? There are a number of criteria that we need to screen to make a proper weighting on those exchanges. Then there is the calculation. Are you going to take a median, an average? Which time period are you going to take to provide that price? There are a number of criteria that has to be taken into account. And you can come up with actually pretty sophisticated type of methodology. And typically when it comes to a market such as South Korea, that's even more complex with local specificities. We've mentioned earlier like the kimchi premium, where typically you have a price gap when it's denominated in Korean won. So what about the currency in which you have the crypto denominated? And I'm not even talking about staking here. So that's give you a little bit about the flavor of the complexity when it comes to pricing a rate or an index. And that's typically what Geico is helping with local players like exchanges or ETF issuers or even regulators in building those standards.
I see. Okay, so lastly, I want to talk about future perspective. And okay, I'm gonna start with Eustace, I guess, because you mentioned about AI and blockchain, right? It's gonna be a hugely like in an age of blockchain and blockchain and AI. So, like overall, how do you see the possibility between them, and how is gonna how are you gonna face as a CoinMarketCap?
Definitely, and I want to pick up something what Jean said before, that tokenization basically allows traceability in the markets. And this is enabled through bringing everything on chain. And here, if you combine this with the pattern recognition of AI, suddenly you get completely new possibilities in terms of data analytics, in terms of forward analytics. So you're not only reacting to the market, you are basically proactively observing the market. As soon as, for example, you see certain capital flows, you can directly potentially see impacts it might have in the future for a certain asset pricing. So combining those two technologies, AI and blockchain, suddenly brings so much efficiency to the market that I believe we will see more and more traditional capital markets instruments being moved on chain. And because the efficiency gains are just too big to ignore. So yes, I do believe that as soon as we are combining those two technologies, that we will see even more adoption, especially from the institutional sides and the traditional capital market side.
Okay. So to Damian, I have a really simple question.
All right.
So,
market trend. So, yeah. So maybe to illustrate the market trend, I'll mention briefly altcoins. I believe crypto cycle don't repeat, and altcoin is potentially a good example. Historically, I'll explain. Altcoin were fed by capital being like rotating out of Bitcoin typically, especially when you get like already a lot of gains being pulled from Bitcoin. That's one of the reason, and it's probably driven by retail adoption or by speculative dynamics. But as of today, it has changed a little bit. Dynamic has changed. We see much less flow rotating out of those main crypto, typically Bitcoin or Ethereum, also because there is much more institutional trading on those assets. So they kind of keep the flow going, and there is also less interest into altcoins. So that's an interesting point. There is also more focus on, in general, into large cap. Let's say like the top crypto asset in market cap, like the top 10, I would say. And there is, as we see, less market share taken by the mid market cap, to say so, like the top 20 to 40 crypto. And then we can maybe to finish on that one is, again, to zoom a little bit on the South Korean market, which is, again, very specific, is Korea loves altcoin. When looking at the market share on crypto assets, Bitcoin and Ethereum represent only 20% on the overall cryptocurrency in South Korea. In comparison, that's around 50% on global platforms. So that's interesting, and maybe it's also because there is a lack of institutional trading in South Korea. So in terms of market trend, I wonder whether there will be a shift in this regard, like having a shift toward more top crypto assets. But overall, I believe, like also as my colleague mentioned earlier, like we have topics like real-world asset tokenization, as well as ETF that potentially matter much more than trading cycles. And yeah, I would say that's just more use cases will bring more adoption in the end.
Thank you. So I think it's going to be the last question, and it's going to be to Jin. So what signals are you looking for that indicate when digital assets deserve widespread integration into mainstream digital asset, digital finance?
Well, I don't know that we're in a position to use the word deserve. I mean, I think our firm has taken the view that this is going to happen, right? That digitization of finance is going to be where we end up. How we get there, when we get there, not entirely clear. But I think that's where we're headed. And from Moody's perspective, as a company, we need to be ready. So I think that means two things. Number one, being ready on the analytical side, and number two, on the operational side. So analytically, we need to be ready to deploy our methodologies, make sure that we're ready to use them in various asset classes as they become digitized. And we also need to make sure that our analysts know the fundamentals of tokenization so that when it comes to how digital finance is disrupting maybe their traditional sectors, whether it be autos or banks or any other kind of sectors, once digital assets become more prevalent in those real-world business-as-usual situations, we need to be able to assess the credit impacts from that. Then on the operational side, I think we are also very busy trying to make sure that our data and our systems are ready so that as more and more of, for example, the bond offering process goes on-chain, we're ready as well. So if we're providing ratings through that kind of new channel in that environment, that's something that requires us to be prepared for. And of course, when we are updating ourselves in terms of data preparedness, we're also looking at it from a process perspective as well. We're also staying very close to our regulators, obviously, because that's a very rapidly changing environment. And finally, just staying close to the market through events like this where we can interact with market participants and understand what we need to do to be ready for the digitization of finance, which we think is going to happen.
Okay, everyone. So thank you very much. I think it was very meaningful to know what data professionals are thinking to make this space to mainstreams. So I hope everyone enjoyed this session as well. Thank you very much. Thank you.